All right, we're going to get started, guys. Thank you all who have joined the call today, and we're grateful to be talking about this new program that we launched last week, our 100% financing disaster relief program. And um, obviously, let me just start off by saying that it's been an incredibly challenging few weeks for all of us who have been either directly or even indirectly impacted by the fires. And well, nothing can really truly replace what was lost. It's really our hope that today's presentation on this unique opportunity and resource will help inspire some optimism in our community. Over the last 10 or 11 days since we launched this program, we have had dozens of conversations with families who have been impacted, who lost their homes, who expressed a desire to return to a place of stability, and who also thought that they had only one option, and that was to see the slow insurance process through. But after hearing more about this program, it's actually inspired us to hear that hope and optimism in people's voice after learning about this unique opportunity, and now people have a renewed sense of hope for the future.
Yeah, I got to tell you, I think, one of the silver linings throughout this whole dreadful experience is, it's been really inspiring to see the community come together, the outpouring of support, people wanting to help. And I got to tell you, today that's where we walk a little bit of a fine line. Obviously, this is financing is what we do professionally. We definitely don't want to come off as, opportunists, but you work with what you have. And these are tools we're excited to share with you. I think this will give us a path towards some stability, restoring again, to your point, some hope in the future. So excited to dive in. Thank you guys for tuning in and listening to us.
Awesome. So let's get into it. Again, welcome everybody who's on the call today. Today's call will be recorded so that if you did want to share it with any family, friends, or any other impacted community members. On today's call, we have a combination of both some of our real estate professional partners and also impacted community members that have logged on to learn more about this program today. And so, we're going to go a little deeper into the call because really today happened because of the outpouring of interest into the program. We really have just received an abundance of inquiries, questions, and calls, and so we thought we just would host a call, and we had over 100 people register for today's call, and so we know that there's a lot of interest in the program, and so again, our goal is just that we're able to provide you guys with some additional information. So like I said, my name is Daniel Arias. For those that view that I haven't had the pleasure of meeting, I am the team leader here at We Fund LA, and my partner Ron Sequeira. He is the co-team leader here at We Fund LA. Let me and there's our contact information if anybody did want to reach out to any one of us or any one of our team members here at We Fund LA. So let's break down who can qualify for the program. I think this is one of the most incredible features of the program. Most people thought that you had to be a homeowner in order to qualify for the 100% financing disaster relief program. And they actually have opened it up to both homeowners and renters. So you could have been a renter where your landlord's home was lost, and you too can qualify for 100% financing. And as many of you know, 100% financing was really just reserved for one group of buyers, and that was our veterans. VA loans are really the only loans out there where you can purchase a home with no money down. And now that they've opened it up to impacted families, I think this really presents a unique opportunity for both homeowners that were impacted and renters who maybe otherwise would love to be homeowners, but they've been unable to save money for a down payment. And so this opens up the door and lowers the barrier to entry to even more people. The primary residence that was lost, we've gotten a lot of questions about, who can qualify and what are the criteria for, the loss of the property, because we've had people call us, that obviously have had total losses, and we've had people that have been impacted. They've been out of their home because they've sustained, major smoke damage and the property is unlivable and very likely will have to be taken down to the studs. And so the underwriting guideline reads that the impacted home must have sustained damage requiring reconstruction or replacement. So there's a little bit of subjectivity there with the word reconstruction. We've had a lot of people ask some very good creative scenarios about, what if my HVAC was damaged and, my HVAC system needs to be replaced? Does that qualify for, reconstruction? And, we've run a few of these scenarios up to our underwriting team. And I think at the end of the day, we just have to look at the intent of the program. What is the intended use of the program? And it's really meant for those families that have, really suffered, devastating loss to where they've been displaced. They can't live in their home anymore, and they're going to be displaced for a prolonged period of time. So obviously, those who've suffered a complete loss qualify, but also those who have suffered a loss where reconstruction or replacement is necessary. The property does have to be located in a FEMA disaster declared area, which all of Los Angeles County technically was declared a FEMA disaster area on January 8th. And so you have 1 year to apply for this program from the FEMA declared date, which was January 8th of 2025. So again, those are just some general criteria as far as who can qualify. Homeowners and renters. The property does have to have sustained damage that requires reconstruction or replacement, and your application must be in the system within 1 year of that FEMA declaration date. One other really great feature about this program is that there really are no location restrictions for the replacement property. And so you can, if you lost a home in the Palisades or you lost a home in the Eaton fire, you can technically move out of the city, out of the county, and really out of the state if you wanted to, and take advantage of the 100% financing option. We've talked to a lot of families who don't necessarily have, ties to Los Angeles. They work from home and they are seeking, lower cost of living in other locations or other areas of the country. And they are able to take this opportunity and this 100% financing program with them to, other parts of, again, the county, the city, or even the country. You can move out of state and still have that benefit of 100% financing. This applies to single family residences and condos. I put the word there, approved condos, because the condo does have to go through a review process. We want to make sure that, if you are going to purchase a condo, that homeowners association is on solid footing, and that, all of the HOA documents are in order. So if you are looking at potentially purchasing a condo, I think that we'll just want to make sure that that condo is on stable footing. And of course, single family residences are the other type of property that you can qualify for. We've gotten the question, if multifamily qualifies, can you buy a 2-unit, a 3-unit, or a 4-unit with this program? And unfortunately, the answer is no. It only applies towards single family residences and approved condos.
Wonderful. Thanks for that, Daniel. I think, that's one of the big pieces is, especially with the ability to work from home, right? I think one of the things that we're going to be looking at is, does that impact your employment, right? You getting something maybe outside of the city, outside of the county, outside of the state, is your employer going to be okay with that? Do you have any restrictions that tie you to a location? If not, to Daniel's point, we can purchase a property anywhere. And I wanted to just kind of go over some of the loan limits here in the surrounding counties. As you can see, Los Angeles and Orange County there top it out at 1.209 million. You've got Ventura a little over $1 million, San Bernardino at 672, and San Diego at 1,077,000. Now, I'll tell you, I think that's one of the big areas of opportunity with this program. We've actually had a version of this disaster program in the past, but it was just never realistic for you to be able to use it here in Southern California because the price of real estate is so high. So the fact that, we had some quick reaction and some quick movements to update these loan limits, really opened up some opportunities to really make this a practical program that we could use here in the area. We do have, if we can go to the next slide, please. We do have a couple of real life examples that we drafted up here for you, just so we can kind of start to translate some, purchase price, and payments. If you look at this, we've scaled it here. We've got a few examples here for you. We've got, these are all 30-year fixed programs. Purchase price at $600,000, right? You're looking at a monthly payment of under $5,000, $49.92. Now, keep in mind that includes everything, right? Principal, interest, taxes, insurance. If you look at $1 million, that's going to put you up at $8,200, $8,237. And if you top out in the counties that allow you to go this high, right, up to the 1.209, you're just under a $10,000 payment. It's nice. These rates are, if you're going to see, if you look at what the average interest rate right now is on a 30-year fixed, you are, considerably lower than what you could get on a normal 30-year fixed conventional mortgage.
Yeah, and I forgot to mention at the beginning of the call, guys, we will open it up for Q&A at the end of the call. So if you did have questions, please drop them into the Q&A box. We will answer all of your questions at the end of the call, and we'll also provide everyone a copy of the PowerPoint deck via email after the call as well. Really quick, before we move on to the next slide, I did want to highlight, as Ron mentioned, it is a discounted interest rate. This is a federally insured mortgage program. It's a 30-year fixed. And if you look at what the 30-year fixed conventional rate is doing today, post-election, post-tariff talk, it's above 7% on a 30-year fixed conventional. So the fact that you're getting about a 0.5% discount on the 30-year fixed note rate is a huge win, because it will lower the cost of your monthly mortgage payment. We're going to go into a little more detail about this in a couple of slides, but I thought maybe it's just relevant to talk about it now. We've got a lot of questions from our clients and our community about loss of use coverage on people's insurance coverage and insurance policies. And we obviously encourage everybody to seek the individual and independent advice of your insurance provider. So if you have State Farm or Allstate or Farmers or Wachovia, whoever your insurance company is, obviously reach out to them to understand the coverage limits and requirements. However, we've spoken to a number of clients who have shared with us that they've reached out to their insurance companies, and their loss of use coverage of their policy can be used to subsidize mortgage payments, which I think is probably, in my opinion, top 1 or 2 highlights of this program. I know it may be tough to digest a $5,000, $8,000, $10,000 mortgage payment, but we've talked to a number of families. One family had $100,000 of loss of use coverage. We talked to somebody yesterday who had $400,000 of loss of use coverage. And when you think about applying that towards temporary rent and paying a landlord's mortgage, it really now becomes a compelling case to apply those funds and allocate those funds to a mortgage, an asset that you own, an asset that's providing you some tax shelters, an asset that, God willing, will probably appreciate over time. We've received an abundance of interest of buyers that have been displaced wanting to enter the housing market. And, I think we were already, even pre-fire, in a very starved inventory housing market. Obviously, this may mean that it becomes even more challenging. And so just with that imbalance of supply and demand, there's a likelihood that we see, home prices potentially going up. And so, if you do have that loss of use coverage, again, check with your insurance company to understand the policy, the requirements, the limitations. But we have received feedback from a number of clients, some of which who have already gotten wires for their full amount of their loss of use coverage. They've gotten wires of $150,000 deposited into their account because the insurance company has paid it all out in one lump sum. And so, again, if you're getting $6,000, $7,000, $8,000 a month for the next couple of years while hopefully, you rebuild and you take the time to rebuild your home that was lost, you have that loss of use coverage to hopefully help subsidize the monthly carrying cost of this mortgage. We'll talk a little bit about, we've got a lot of questions about, well, what happens with the existing mortgage on the home that was lost if you did have one. We'll talk a little bit about that on the next slide.
Before we move on, Daniel, if I can just a couple quick highlights of what you just mentioned that I think is important. And forgive me, I'm a bit of a finance and guideline geek. So, just to understand the logic of where this comes from, right? If you're buying a replacement property that, you eventually want to move back, to the home that you rebuild, right? So I think that's where the key feature is where, I'm sure, again, and I'll say this till we're blue in the face, please check with your insurance company to go over those specific guidelines and what they require. But I think where the logic is coming in that allows for this is because this is temporary, maybe a temporary home that you'll own, right, before you move back. And the timing comes into play, right? Because it might take 2, 3, who knows? It could take years before that home is finished and you can actually move back. Now, pair that with the fact that we have a primary residence requirement for the home that you're purchasing, right? This replacement property. And the occupancy agreement on our end is 12 months, right? So that's normally what you say, hey, I'm going to make this my primary residence, right? And that occupancy agreement lasts for 12 months. So after the 12 months, once the home is finished, if you move back, I think that's, probably where the key detail is that some of these insurance companies are looking for is probably the intent to move back to the original residence. So again, I'm not an insurance expert. Definitely go back and check in with your specific insurance company's requirements. But just wanted to touch upon that. Daniel, I'll let you take it away with the program requirements.
Cool. Yeah, so a couple of just the high level program requirements. Everyone's asking like, what do I have to do to prove that I've been impacted? And there's a couple of ways to solve for that. Obviously, if you've had a total loss, you can provide a copy of your insurance claim or some sort of FEMA claim declaration that you have filed directly with FEMA. If you were a renter, then we just have to establish residency and occupancy that you lived at that address for the last 6 to 12 months. And there's different public websites as well that we can use to document, a loss. If it falls into one of those gray areas that we talked about earlier, where maybe the house is still standing but has sustained severe damage to the point of reconstruction, then we would ask that the landlord provide us with a copy of the insurance claim. That way we can document the type of loss that was suffered by the homeowner or the renter. This I guess as a side anecdotal note here, when we launched 100% financing, it did for a second give me, a little bit of PTSD because we all remember what happened last time 100% financing was launched back in 04 and 05. However, there's a big difference this time around. One is that you have to qualify. I mean, this is a full income asset credit analysis. This isn't a, just apply and you're off to purchase a home without providing proof of the ability to repay. And so, this is a full income documentation requirement. Unfortunately, you can't get creative with how you qualify, the documentation you provide. Many of you have heard our team talk about, bank statement loans and other ways of qualifying self-employed borrowers. And unfortunately, this program does require, again, a full income qualifying method, which means, you're providing and qualifying based off of the reported income on your tax returns or your pay stubs or a combination of the two. So as far as credit goes, again, there'll be another slide on this, but this actually does go down pretty low on the credit qualifying. That's one area that does have a lot of flexibilities on the credit score because we understand, and this program understands that people may have been impacted to the point where they have to start incurring some credit card debt. Maybe they've lost mail and they haven't been able to get their bills paid on time. And so it's really cool to see that this program accounts for that and understands that maybe you haven't been able to get to your mail to send your normal bills every month. And maybe you have missed a payment if you don't have everything on auto pay. But if you did have a missed payment, and your credit score was impacted, this program does account for that, does allow you to get down to, all the way down to a 580 credit score on the qualification of the credit score. So obviously we'll need, if you do own, real estate, or you do own, or you have a significant real estate portfolio, all of that's documented with, either mortgage statements or, your tax returns as well. And so every case is different. Every borrower's income asset profile is different. And so there may be nuances to every unique borrower's profile, and we'll assess that on a case by case basis. But I did want everybody to know, this is a full income qualifying program, and we want to make sure that, you do have the ability to repay the desired mortgage that you're taking on. We did also get the question about, does that loss of use coverage count towards income? Can you apply that, $100, $200, $300,000 of loss of use coverage towards income? The answer is no, right? Because that's not a guaranteed source of income, for years to come. There's going to be an end to that. There's finality to that. So you can't use the loss of use coverage to count towards your income. You can use it towards your assets. The one client that I referenced earlier that had their entire loss of use coverage paid out in one lump sum actually wanted to buy something around 1.3, and they said, can I just bridge the gap? Can I use my loss of use coverage that just got wired to me to purchase something up to 1.3? And I'll put in that $81,000 gap with cash. The answer is yes. You can apply loss of use assets as additional funds towards, down payment if you did want to exceed the LA County loan limit or whatever county limit there is. But you can't use it as income. So I just want to make that distinction.
If I could just kind of recap with just some highlights of the program features for you guys. Obviously, it's a 30-year fixed rate. As we mentioned earlier, you are going to see discounted rates on the program. As Daniel mentioned in the slide previous, we got, flexibility on the credit scores. And, here's one, as maybe as serious as like, the full income and credit qualification sounds, you are seeing a lot of flexibility on the program, right? So we are able to push, like where a normal debt to income, limit might, really cap you off or be pretty strict. We get pretty generous underwriting guidelines on this. So we can push. Again, we obviously want to do the right thing, make sure that we're putting you in a situation, that, you're not feeling like you're drowning, or living beyond what you're able to. So we do take the responsibility of making sure that that fits within the budget, but we do get that flexibility, right? Especially if you're having to swing the house payment on the old property and the new house payment on this one.
Yeah.
Again, there's no down payment requirement. Keep in mind though that any transaction has closing costs, right? Closing costs, taxes, and insurance, right? So we will need to account for that. But if we can maybe put that into the offer, maybe see if we can get some seller concessions to pay for that. But I will say on that, there's no additional cost for the program, right? So it's not like you're paying any premium, any hike on, discount points, which is normally what you'll find when you see any type of either first-time home buyer programs, right? Where you're seeing some bonds or some support trying to help people get into homes. Oftentimes you're seeing an increase in those fees as well. So this has no additional fees, no income restriction, right? That's another thing you'll sometimes find with some of these assistance programs. It's like, well, you can only make so much income per year. So no restrictions there. And it is a federally insured mortgage program. So this is insured by HUD. I think, it's one of the big things, like I mentioned earlier, is seeing the quick reaction, seeing the update on the mortgage limits, right? Sometimes these HUD programs can limit you as far as what you can borrow. So it's nice that we've got a practical use here locally.
Yeah, and just as another side note that literally just got approved, we didn't even have time to put it into the presentation because we literally just got this approved this morning. But we reached out to our senior leadership to see if there was anything that we could do as a team. I mean, where We Fund LA, it's taken on a greater meaning than we ever imagined We Fund LA would take on. And we wanted to make sure that we were helping in some way other than you're just providing this as a resource. And so we got approval to make sure that there's no lender fees on these loans and there's no appraisal fees. So you'll see that your lender fee is waived and the appraisal fee is waived on this loan. still have to pay title and escrow. Those are third-party fees that go to other vendors that we don't have control over, but we do have control over what we charge as a lender, and that lender fee is waived, and the appraisal fee is waived and refunded to you at closing. So that's just another one way that, we want to try to help in a small way that we can to try to have people return to that place of safety and stability. So
Exciting. It's great news. If we can hop into just some frequently asked questions that we've been getting here over the last couple weeks. Daniel, if you don't mind speaking to some of these, if question comes in, what happens to my current mortgage?
that's a really good question. We've gotten a lot of questions about what should I do with my existing mortgage. If you do or did have a mortgage on your home that suffered loss or was destroyed in the fires, you have a few options, right? You can either continue to to pay that mortgage, or you can request forbearance or deferment. So you have options, and it really all depends on what your future goals and plans are, right? Because calling your servicer and calling your mortgage company to stop and pause mortgage payments is something that you absolutely can do, and from what I understand, most, if not all, servicing companies are giving some sort of assistance to people that have been impacted. We service a vast portion of mortgages that we fund. We actually service 95% of the loans that we fund. We have a huge servicing center. And actually, just another side story, just to share with you, we had a dear client and friend of ours that was impacted. Literally just got his keys last summer on Mariposa, and he lost his. He was impacted, was unable to go and return to his home, and he reached out to us and said, Daniel, like I need help. I cannot pay the mortgage. I'm trying to figure out what I'm gonna do for me and my kids. And I called the head of our servicing department, Roger Stotts, and Roger said, here's my cell phone number. Have him call me directly. We will get him help. And that was, to me, just an incredible sign that we're willing to do whatever we have to do to get our clients the support and the help that they need. And so in some cases, forbearance deferment is absolutely the right choice. If you do have any intention of borrowing in the future, whether it be, for a mortgage or some other sort of financing, going into forbearance or deferment could impact the ability to borrow in the future. Kind of the soft rule or the soft guideline is that, once you enter forbearance and you've exited forbearance for a period of at least 12 months, that's when you can actually apply for financing or a mortgage. So I can tell you that, if you made your January payment like you probably normally did in January, you technically haven't skipped February because you have until February 15th to make your February 15th payment. So even if you did call your mortgage company, we had one client say, I really want to take advantage of the 100% financing, but I actually called my mortgage company and I put my mortgage on pause on a 6-month forbearance. Well, he's not in forbearance because he technically has not skipped his February payment. So he called them right back and said, cancel that. I want to go into forbearance. I want to stop the forbearance. I want to continue making payments. And, he sent in his payment on February 1st. So, there is no forbearance in that situation. And, the client will be able to purchase a home. The same client did ask, like, well, what happens after I purchase a home? And I wanted to go into a forbearance after the fact. I can't tell you what you can or cannot do, what you can or cannot request in the future. But I would imagine that, forbearance or deferment in the future, could be an option if the servicing company is willing to extend that offer after the fact. So, yeah.
I'm glad you touched upon that. That's actually one of the questions that we had was that forbearance period, right? And I think a good note on that is speed to action, right? Like I would say, get on the line with a mortgage professional, talk through these options because you could be putting yourself in a situation. Don't get me wrong, it's great to pick up aid wherever we can, but I think it's just good. How can we do that planning for the road ahead and making smart, responsible choices that aren't putting us in a corner or, taking any of those options away from us?
Yeah.
Daniel, I know you talked earlier about you gave us a specific scenario of, bridging the gap. And I know that's one of the questions that we get, what if there's a property that's listed above the county limit, right? What if somebody's looking at a 1.5 or $2 million property, right? And how how does the program and the limits affect that? And what would your suggestions be in those cases?
Yeah, the program is highly effective up until a certain purchase price. And then after that purchase price, if a borrower does have capital or assets that they want to contribute into the transaction as by way of a down payment, then there's going to come a point where regular conventional financing becomes more practical at that point. And so we will just do the math for the client to figure out, if they have 50, 100, 200, $300,000 that they want to contribute as a down payment into the transaction. At some point, this program will not have the impact that it could have. Really, the 100% financing is the big feature, the big draw, and then a little bit above that. But every county, like we talked about earlier, has its own individual limit. LA is considered a high cost area, so LA has the highest limit in the country at 1,209,000. Orange County is the same as LA County, but then you start going into like San Bernardino County and Riverside County. Those have lower limits because the median home price is lower in those counties. And so, we have the full list. If anybody has questions on a specific county in our state or in the country, we are more than happy to provide you with that limit as well. And again, as we finish up here, there's just one or two more slides. Encourage everybody to drop any questions you have in the Q&A box, and we will get to those at the end of the call. I know we've already got a couple of questions in there, but please don't hesitate to drop your questions into the Q&A chat box.
Daniel, I'm gonna beg the question. I know we talked about it already, but how does my loss of use coverage come into play? We want to reiterate the main message there once again, but
yeah, no, I honestly, it's worth repeating because I think it's so impactful. When I started getting those questions from our clients, I was like, huh, that's interesting. Like maybe you can. Why don't we? And I called my personal insurance advisor and asked him, hey, can I use my loss of use coverage if I was impacted? And what I have my homeowners insurance through State Farm. I said, what is State Farm's position? And I'm not speaking for State Farm, and I'm not speaking on their behalf, but he confirmed that on a case-by-case basis, if they if the client does state that this is temporary housing and that they are purchasing a home as temporary housing, then that they would look at that and consider using loss of use coverage towards the application on mortgage payments. And so, it is worth repeating because I do think that it's a pretty impactful argument to make when you can use these funds to subsidize mortgage payments that are elevated because you're putting nothing down. So we had one client state that kind of was turning a negative into a positive. He lost his home. It was a total loss. And it says, so Daniel, I may end up with like a little investment property at the end of all of this. And hopefully my newly rebuilt home in a couple of years. I said, theoretically, yeah, you'll end up with a property that you were able to buy with no money down that you can convert into an investment rental in the future. And, hopefully in the next couple of years, 2-3 years, he's rebuilt his home in Altadena and has moved back into that property. So
after we've satisfied the primary residence requirement of living in the property for 12 months, just to be compliance clear on that.
Yeah. And I know the last question touches on forbearance, which we just talked about. So we can move into the Q&A section. That is all that we have as far as the presentation goes. I think I'll sum it up by saying that when we launched the program and our team really started digging into the underwriting guidelines, I mean, you should have been on the call. We were literally on the phone with our head of underwriting saying like, wait, like where's the catch? Like we feel like this is almost too good to be true. And truly there is no catch because this program is truly meant to help those that have been impacted at a high level. The fact that the rate's discounted, the fact that we're waiving our lender fee, the fact that we're waiving our appraisal fee, the fact that you don't need any money out of pocket other than your closing cost. And then those can even be covered by potentially a seller credit if you're able to negotiate one through your escrow. This really provided an opportunity, an alternative to so many people who thought they had one option and one option only, and that was to live in short-term housing and a short-term rental, to rent, to live with family, or worst yet, a hotel. I mean, like we've heard some unfortunate stories of people not even be able to find permanent temporary housing. And so this is a really incredible opportunity that we're very grateful to be able to share with our community. And so we'll get to a few of the questions here that have come in the chat box. The first question has to do with income qualifications and how does that work for retirees? Ron, do you want to tackle that?
Sure. Yeah. I mean, retirees, the debt to income qualification is ultimately going to be the same. Where retirees get some benefit is you'll have income that is not taxable. So when we look at that income, we'll be able to calculate a factor where we're grossing that up, right? So we're actually taking into consideration more income than actually what gets deposited into your account. So that allows us to, you know, give you a more accurate debt to income qualification number. We can push those limits. So we can push that to, again, depending on, the overall credit profile and what the system likes. But in best cases, we can go up to right under a 57% debt to income ratio in most cases if the file is strong enough. And what that means, just to translate that, is we look at the income on a monthly basis and we say, okay, well, what's the limit that this person can spend, right? So we allow that to go up to 57% of that income. And again, as I mentioned that, even though we are able to push those limits, I think, we always take the responsible approach of going over a budget, making sure that we're not overextending ourselves. But we do have some flexibility there.
We got a question from a family that were renters, and it sounds like the house sustained severe smoke damage. The home is unlivable, major damage into the insulation, HVAC system. Sounds like the property is being now listed for sale by the landlord. And the question is, in this case, would that family that was renting qualify for this program? And my answer would be yes. It sounds like that property has sustained damage to the point of, major reconstruction or replacement. And even though the property is for sale, even though the property, is going to be sold, in the near future, you as a renter being displaced, and that property is now going to be sold, and it's sustained, looks like significant damage. You as a renter do qualify for this program. Obviously, we'll need to document that damage, as long as your landlord is willing to assist us with insurance claims, et cetera, getting a copy of that. The one alternative too, we hadn't really talked about this, is that there are qualified inspectors that our underwriting team will also accept reports from. So you can hire either a general contractor or qualified inspector to go through a home and say, here's my inspection report. This property has, this much damage or this type of damage. And again, I think we just, at the end of the day, just want to use common sense. And it sounds like, unfortunately, this family is going to be displaced for a significant period of time. It's not like they can just do a quick repair and they'll be back in that home in a couple of months. It sounds like that's going to take quite a bit of time to address. And so my answer
I
to that
think,
family would be yes.
sorry, and I think another thing to mention is, there's not a cookie cutter scenario, in these circumstances, right? You're going to have just all types of variations to, what's happened, what condition the property's in. And sometimes, we're going to have to run the experiment, right? And I think that's one of the beneficial pieces of advice that I give is, you know, let's get that pre-approval done. Let's take the application. We can actually submit it to the underwriter, person that's going to be signing off that loan when it funds, and do that pre-inspection, make sure that way we can go into it knowing exactly that we have a good viable strategy that we could use. So anytime we have something in gray area, I always say, hey, let's flush it out, let's make sure that we can get it done for you.
Yeah, we have a good question from one of our friends and partners, John Cabezo, a realtor at Compass. He's asking if a client is able to obtain homeowners insurance if they have an active claim on their home that they have that they sustained a loss on. That is, from what I understand, California Fair Plan is still insuring clients and borrowers who have active claims and open claims on a damaged property, along with other carriers as well. There was a moratorium shortly after the fires for about 4 or 5 days where the only one option in California was California Fair Plan. But soon after that, as the containment numbers increased, more and more carriers returned and lifted the moratorium. But in the last, I would say 2 weeks, we had a very active pipeline pre-fires, through the fires, and even post-fires now. We've continued to lend, we've continued to fund loans, we've continued to find clients that are able to obtain insurance options, albeit, maybe at a higher cost, albeit not at the best and greatest coverage, as insurance companies are continuing. I'm sure everybody saw today, State Farm's already asking for California's permission to raise premiums by 22%, and 43% on rentals. But I think that the answer is yes. From what we have seen, we have yet to have one transaction that has been paused. Actually, I just thought of something. We just literally have funded a loan for one of our clients who lost her home in Altadena, bought another home in Altadena off of Lincoln. This is all post fires. And she's like, I have kids, I need schools, I need stability, lost my home. There's a property off of Lincoln, I want to buy it. And she made an offer, got into escrow, and we literally funded her loan like all within the last 2.5, 3 weeks. And so she had an open active claim, and she was able to get, insurance. She actually got it through it was a California Fair Plan plus a wraparound policy with another carrier. So long story short, there are options out there. We got a question about another qualification question about, how we qualify self-employed borrowers. For self-employed borrowers, it is going to be the documented income, the taxable income on tax returns. That is what we're going to be looking at to determine debt to income ratios. So even though you may have, a steady stream of revenue into your business bank statements, ultimately for this program, you do need to qualify based off of your taxable income. We do have other programs that can qualify you based off of revenue into your business bank account, but those do require a down payment. Those are not, 100% financing options. So if that's something that may work for you, please let us know. And, kudos to Matt Gerard from our team. He actually reminded us, if you guys don't know Matt, one of our top loan officers here, and he just reminded us that obviously it's tax season. If you are self-employed and are about to go see your accountant, many of you maybe have punted that meeting because we've now got an extension on the tax deadline. But if you are self-employed and you are thinking about using this program, I would say, maybe get with us or get with your mortgage advisor or get with your accountant to make sure that your accounting strategy for that year is conducive to you qualifying. So I would make sure that you're all working as a team to make sure that you file tax returns in a way that, or will help you qualify. Make sure we take a look, your accountant takes a look at them, and we can all work as a team. So thank you for that reminder, Matt. We have a question about forbearance. Is a home equity line of credit forbearance will that also impact the ability to borrow? And does that affect the borrowing ability? Ron, you want to tackle that, getting forbearance on a mortgage and or a home equity line?
Absolutely, yeah. I mean, a home equity line of credit, because it's still secured by a property, if you're pausing that, or if you're going into forbearance on that, that is going to be treated the same as a regular first mortgage would. I think the important thing is, like we mentioned earlier, do you then continue and pause it or not, right? And I think it's important, happy to, connect, do a consultation, kind of go over the specifics, see if the numbers, if this is a program that you'd like to take advantage of, right? And run through the numbers, see if it's something that you would, and if not, maybe pausing that payment is the best thing for you, right? But I think it's important to kind of run through the specifics, as far as to whether or not you do it. But to answer the question, yes, if you're pausing anything that's, tied to real property, to real estate, it's going to be treated as a forbearance, and the same rules apply. Great question.
We're going to wrap up with one more question. There are several other questions in the chat box, and if we didn't get to your question, guys, we will get to you individually if you listed your information. If not, you can send an email to info@wefundla.net. info@wefundla.net. You can send your question directly there, and one of our team members will respond directly to you. But we'll wrap it up with one last question about refinancing. Someone's asking a question about, can you use this program to refinance an existing loan. They didn't give a tremendous amount of detail, but if you're talking about trying to refinance a mortgage on an impacted property, the answer is likely going to be no, because part of refinancing a mortgage that's on an impacted property requires, an appraisal and a full market analysis on marketability. And so, if you had a mortgage on a property that was lost in the fire, that collateral is no longer there, and so you can't refinance the existing mortgage that you have on that property. I hope I answered that question correctly, but if there was any additional detail that you wanted to provide us, please email us at info@wefundla.net. There's a ton of resources and information on our website at wefundla.net. And we'll continue putting out additional information about the program to everyone through our social media channels, through our website. And we really appreciate everyone who either is a community member that was impacted or our real estate partners for joining today's call and for spreading this resource. If you know anybody that was impacted and they want additional information, have them reach out and we will provide them the same information that we gave on this call today. So appreciate everybody. Thank you so much and have a great rest of your day.